lower the cost of your premium by shifting into claims or a status where your 1% of your home value is your deductible versus that flat amount. And you and I talked about that might be the trend. Do you believe that that is where things are going?
From what I've seen for new, for the most part, most companies are going to some version of that. Not everyone is requiring it yet. Almost all of us have it as an option from what I've seen. And some are requiring it. For American Family, for new clients coming in right now, our homeowners deductible is what's called a split deductible. It's $1,000 as a minimum for your traditional claims, your fire, your water, things like that. But if it's a wind or hail claim, it's 1% of the dwelling value. And that's our minimum right now. Again, those things can change as time goes on, but we're seeing a lot of that. We're seeing on the commercial side, and we're talking a lot about commercial today, but I've seen with commercial buildings, whether that's a building leased or rented to others, or even a habitational, like apartment complexes and things like that, we're seeing those deductibles be more like a 5%, sometimes 10% of the structure value. You're seeing that a lot more with the homeowners associations, those kinds of things. That percentage deductible is going much higher. And so those are things that are, again, we're, from a company standpoint, they're trying to mitigate that risk. Also trying to help out in some aspects with the budgeting, because if as a homeowner you can take on a little bit more of that risk through self-insurance, there can be some reduced premium because of that.
Great, cool. Let's do a quick door prize, and then we'll come back to your question.
I'm going to grab 5 of them and I will deliver them to you, but I'm just going to do them in order. So Teddy, Rose. Okay.
Right here.
Matt, right away. Okay, I'll bring it over to you, Teddy.
She knows her glasses are right on her head, right? You know your glasses are right on your head.
They're always there sometimes. James Unger, which is, yeah, there you are, James. I'll bring that over to you. Sharon Deline. All right, Sharon, there you go. Oh, and Heidi Winan. It's funny when you're in a different place. I met Heidi a couple years ago, and I didn't recognize her. And she goes, "You've been to my house." I'm like, "It's good to see you." So. And then Chad Riggleman. So I'll deliver.
Cool.
All right.
Go ahead with your question.
Just that clarification, so based on 1% of home value, that's could be pretty broad when you look at, like, I'm assuming it's based on the insured value, right? Not necessarily your tax value versus what you could sell.
Correct,
Based on the
yeah.
insured value, right?
We're talking about the insurance policy. Generally, all of us call that coverage A or dwelling coverage. And so if you've got a $500,000 home that you're insuring for $500,000, at 1% deductible, you're going to be at 5.
And then regarding what one of you were saying on the hail, is that just a local thing where my understanding with like steel, roofs and siding is with hail, they're not covering that anymore? And is that a local thing, or is that ubiquitous across the entire country now, where they might not cover hail coverage on steel, siding and roofs?
I would say, from my knowledge, that is going to be more of a company thing and somewhat geographic in what they do. So American Family, for example, we cover steel siding, steel roofs. We've got cosmetic coverage available, and in most cases we can buy that as an add-on with our new policies. Some of our what we call our classic policies or legacy policies, that is built in, it's inherent in the policy at this point. We haven't removed that. We've seen some of that on our farm policies that started to go away. We've seen some of that on commercial policies start to go away, so I can't say it'll always be that way, but it definitely, it's a factor now where it's more of a buyback option, where somebody can decide, does that matter to me or not?
Good. Jamie.
I got a quick question, and I don't know if you're going to get into this later, but in our last Monday, you had brought up the days of, y'all hope for a hailstorm, right?
Yeah, who's prayed for a hailstorm in here?
Right, and that's a good point, because we all used to do it, but that's kind of changing, right? And there's such things you just brought up about the cosmetic aspect, that's, back in the day, it just was part of your insurance policy, right? And, whatever, now, you have to look more at riders and endorsements
Yep.
and stuff.
Let's come back, we'll come back to that, so, nope.
At one point you were gonna.
Yep, nope, that's good. Going back here, I want to dig in a little deeper, Andy, with long-term care. When you're someone that's in your 20s and 30s, you're not thinking about, those sorts of things now. You're barely thinking if you're just having kids, you're thinking about college. Long-term care is probably one of the furthest things from your mind when you're 20s, 30s. At what age do you kind of recommend, or do you start to have conversations with your clients when it makes sense? Tell us a little bit more about what we should be thinking about, thought process, what it does cover, what it doesn't cover, but through a typical client, how do you walk them through when it starts to make sense for them to start planning on long-term care insurance?
And there's never like a perfect answer on that one, but like industry, like generally, the sweet spot to be looking for long-term care planning is probably like in your mid-40s, like 45 to 55 range. That's kind of a good spot. Now with that said, you could have a claim that qualifies for that. I mean, 30 years old, right?
Yeah.
I mean, so there are ways to kind of put yourself in a position to have the control and the choices later. The traditional long-term care planning or benefits and policies put in place, there's only like a handful of carriers left that really are, providing these traditional long-term care benefits. And a lot of other insurance carriers that do life insurance are now allowing like riders attached to a life insurance policy that allows you to access your death benefit early for care if you qualify for the care. So one thing that you could do for those that are a little bit younger to put in place is that if you buy a term policy, there's some carriers that will allow you to add what's called a rider for chronic illness conversion to convert to a permanent policy later on. They have to call it chronic illness because the state of Minnesota can't call it long-term care, right? They have to call it chronic illness. So how that works is, let's say you buy a $500,000 term 30-year, and at age 50, you're like, well, I'm ready to do some long-term care planning that protects my assets, and you take $200,000 and move it into a permanent product. You can do that if you have this rider with no underwriting at all, and you just move it into the new permanent. Now you have to pay your premiums at that attained age, at age 50 in this example, but you're locked in. And if you had a claim, and it depends on the carrier and how it works, but you can draw out a certain monthly benefit. Some will allow you up to like 4%, so $200,000 face amount in this example, you can get $8,000 a month. Now that's kind of close to covering some, right? That if you do the math, it's about a 2-year that you get, but you're using that death benefit without having to dip into other types of assets and drain other assets to help protect.
Can those policies accumulate a cash balance similar to a life insurance?
Yes, however, if you're using it for that, it's more on the protection side, so you still want the accumulation of the cash because that's going to help pay for your premiums later.
Okay.
But if it's structured properly, you have the right premiums in there, and there's ways to do it without your premiums going up, and it's
perfect
set price.
Yep.
So it's a great way, another way to provide some protection without having to buy a normal traditional. Now, pros and cons of this, because with the state of Minnesota, there's what's called a partnership program. I'm not going to go into too much details on that because it's a little more confusing. But essentially, it does not qualify for what's called a partnership program with the state of Minnesota. And getting into a traditional long-term care policy, we have that, which can be more expensive because those premiums go up anywhere from 19 to 35% on average each year. And it's not just set, and it definitely goes up every year. But let's say if you have a benefit on a traditional long-term care and it's paying them a daily or a monthly benefit, and you get a pool of 100,000, for an example, you can protect that 100,000, spend down your assets, and then, to qualify for Medicaid, and you still have like 100,000, whatever that benefit amount. The previous type of policy does not qualify for that. Okay, but it has way more flexibility. People like it because it's way more affordable on the life insurance side. And there's more flexibility because if you're paying the premiums and never have a claim on your traditional long-term care, you're out kind of that money. Where the insurance, the life insurance option, you're paying that premium, you're going to have a claim on the life insurance for sure at some point, right? And if you do have a claim on the long-term care, then you got some protection of assets that benefit that can be helpful.
Yep, and then what I'm hearing is whether it's long-term care, trust, homeowners insurance, it really is an individual, your scenario can play so many different factors on what you decide, what path you decide to go down. So it's important to ask some of these questions because it's not a one-size-fits-all by any stretch of the imagination, right?
Correct, yeah. I mean, you got insurability, right? And that's a huge deal, being insurable.
Yep.
And your whole situation, I mean, yeah, it's not a cookie-cutter thing. It's a situation for everybody.
Yep. So Lori, I know there's been some developments here recently with some precedents with trusts and long-term cares. Maybe explain to us what's developed with that, why long-term care is not part or cannot be necessarily protected, or want to give us a little bit of those details that's changed here?
Sure. I don't know if there are too many changes, but one of the things that when people come in and they want to do trust, they kind of feel like, okay, that's going to protect all my assets from long-term care. If I don't have any of those great products that Andy was just talking about. So there's a 5-year look-back period. A lot of people kind of hear about that, right? From the time that you apply for medical assistance, they will look back 5 years. And if you made any transfers, it's called the clawback period because they can claw back those assets that you transferred. So the only way to really avoid a medical assistance lien is if you give your property away during your lifetime and then wait the 5 years, because then it's no longer your property. But like with everything, there's a lot of risks and dangers in doing that, because you think about it, if you want to give your real estate, which is one of your primary assets, let's say you want to give that to your children during your lifetime because you think that's a great way to avoid, the nursing home taking your real estate. But the issue is you have capital gains on that, because the people you give it to, that's not their primary residence, right? So you kind of create a tax liability when they turn around and sell it. But I've been doing this for 20 years, and it's amazing how you see things that is like, wow, I didn't see that coming, right? But I've actually had where an elderly couple, they decided they were going to transfer their real estate to their children who were about in their 50s maybe, right? And they decide, yep, we'll just wait that 5-year look-back period. That's our primary asset. That's what we want to leave something to our children. You hear that so much, right? Well, the sad part was the couple were maybe in their late 70s, early 80s, and the child that they transferred the property to during their lifetime ended up having a stroke and going into a nursing home. Well, guess where that real estate went? It went to the son's nursing home care. It's no longer the parent's property. So there's a lot of dangers of doing that. So you really have to kind of sit down and, I always say, talk to your accountant, find out what the capital gains are going to be, because they can be really significant, especially when you talk about family farms, where, my grandpa bought it for $10,000 and now it's worth millions of dollars. It can really create more harm than good. So you really want to take a look at that.
And maybe you transition to what is referred to as the clawback period, or what you alluded to that, but tell us what that is. It's 5 years in Minnesota, is that correct? Or
5 years, it used to be 7.
Okay.
So what that means is if you give your real estate away to your kids, and let's say only 3 years pass before you needed nursing home assistance, basically what they do is they determine what the value of that asset is that you gave away during that 5-year look-back period, and you become ineligible for medical assistance for a period of time in which they calculate that asset could have otherwise been used for your care, okay? So So basically, you're stuck with private pay. And if you don't have any other assets, you don't private pay, right? Then you should get family members who are stepping in to either care for you at your home or selling the real estate that they did get or whatnot. But anything within the 5 years, they can claw back, meaning they can use that to determine when you become eligible for medical assistance.
I have a question on that.
Go ahead.
What about if 3 years go by, right, and then you end up in long-term care or something like that, and you can kind of cash roll those 2 years, the 5 pass, then you're good to go?
Yep, yep, just don't apply.
Yeah.
Because it does start from the date you apply, then it goes 5 back. So if you're gonna pay, private pay for 2 years to make that 5, just don't apply for medical assistance
So you just
until
need to
the
make
5
sure
years.
you can get to 5 years, that's the goal.
Correct.
Save enough for 5 years.
Correct.
Okay.
That's the short answer.
Yeah.
Yep. Go ahead.
If you give away your assets, call it $2 million between land and whatever else, while you're still alive, I'm assuming there's still capital gains.
That's a whole different,
Dependent on your state while you're still alive, correct?
if there's a transfer, and none of us are an accountant,
Yeah.
but whenever there's a transfer of ownership, there's implications of,
So you could still lose 30-40% of that asset on that transfer, even if you did do the 5-year thing, you still lose 40%, but to avoid that, you can still do upon death, you could do a one step up in value on land and real estate, correct?
Correct. Yeah, but I think the issue kind of becomes when you're playing with the odds, what I tell people is medical assistance, nobody knows if they're gonna need it, right? So you're playing the odds. Capital gains, you're locked in, they're capital gains. You created a tax liability that's certain. So you're taking a certain obligation to roll the dice with maybe
Right.
something that
Regarding the
happens.
long, I agree with that, but like as far as like your original statement was wanting to give your kids and grandkids something, I think if people are looking into just transfer while they're alive, I think it'd be, based on my logic in my head, I'm thinking the number one thing would be long-term care. Second would be life insurance.
Because if you're a conservative person, you could have a hard $200,000 pay off those debts straight away, but you can squander a quick fortune in long-term care for 10 and 20 years. And so I'd say if I was going to put arbitrage or like triage on it, I'd say long-term care is number one, that life insurance is number two, and then the third thing would be if you want to give your kids something, be able $1 million, $2 million, $3 million, whatever millions of dollars, it's based off the fact that you could lose anywhere as minimum, you need 25 to 40%. You're better off probably like with the long-term care, you protect your assets, and then you can then do a one step up in value on any real estate, which you said most people who are middle class and upper middle class, that's where your big nest egg is. And they'd be much better off not transferring while you're alive, like what you're saying, and waiting upon death, upon both individuals, like the parents, then you get a one step up with value on any real estate, land, property.
you should be teaching this course. This is great. I think, go ahead, Heidi.
Autos. We actually touched on there last week, and we were leading of a certain topic that we were like that we should talk about that a little bit. So one of the things they're leading to is, bring two things that they're talking about with Dow right now. One would be that, you want to avoid taxes. That's something they all think about. But you also want to avoid having an asset that you worked for your whole life just going to pay for your medical bill. I think that where you get a group of professionals involved is to say, okay, what is the better app, and what is the circumstance? But then if you have, for example, a family farm that's been for several $1 million, that's going to be a different scenario than somebody whose mom owns a $140,000 phone, and you're like, it's okay, Mom, we want that to go towards your care. That's fine. We don't need that money. It's not going to change our life. So it's going to be a different scenario. And I think what we're talking about is truly we're saying your insight is excellent. It's very, very good. But it's really going to depend on what that asset is worth. And that's why the consult,
Yep. Maybe Lori.
but when people do come in to talk to me, the first thing I'm saying is looking at capital gain. I'm a big one that information is power. I say that all the time. So to me, when somebody comes in and they're talking about exactly what you're talking about, right? I'm not a tax attorney. So the first thing I do is, go to your tax account and find out what is the cost basis on your part. What would capital gains look like for you? Because how do you assess a risk if you don't put a number on that, right? And you're not going to get that number from me. And then the other thing I'd say is, we'll talk to your financial advisor, because there's other things that you might be able to do, right? There's some people who, for the first time talk about estate planning when they're in their 80s. Well, long-term care might not be an option for them when they're that old, right? And other times they're talking about they have kids, or they want to do different things that don't work quite as good under different circumstances. So I agree that it really is a case by case, but it's a collaborative effort with multiple factors.
Yeah. Lori, just maybe take a step back. Oh, come on. I just want you to describe, because we're talking estate planning in depth here, and a trust is an instrument in the big picture, but we haven't talked about a will and how those two fit together. Maybe speak to us a little bit on how, in conjunction with a trust, and the role of what a will plays into laying these things out, how they work together.
So usually if you have a trust, you're going to have a over with the different kind of will. But I would say it's a safety net, that will, that horrible will, right? It catches any assets that you didn't transfer into your trust. So let's say, it's really common. Don't forget to put bank accounts. They don't put any beneficiaries on. Okay. If it gets over a certain amount, it's got to be probated. Okay. So if you have a poor over will, that poor over will, you still have to go to court. You still have to go through that full 9-month process I was talking about. But then it just in the avenue basically to get it into your trust. But if you don't have a trust, then you just have a will. And you can have the same provisions in a will as you do in the trust. So you can say who gets what, when, what conditions you want on it. Sometimes people stagger it out. Sometimes people use an inheritance of kind of a motivation. I want my kids to go to college. So if they go to college to get $50,000. If they don't, they can leave. So they're worried. People have all different kind of ideas. I always say it's your money. You can do what you want with it. So a will and a trust can do both of those. I think the big difference, like I was saying before, the will, that's what you have. You're going to go into probate for it. And it's just a longer, more expensive process. But everyone's got different views, right? I have some people where I say, if you have a will, you're going to have to sort of probate. That might cost you $5,000, right? And some people are like, well, that doesn't make sense. I'm going to do a trust so I can avoid that full process, right? Other people are like, what do I care? I'm dead. Everything, when you talk and you come in, everyone's got different ideas of what they want. And what's important to one person is not important to me.
Yeah.
Those things, but you do get those facts on what is my food.
Yep. Go ahead.
So my parents have a trust set up for that. And I'm thinking about a trust. So I don't even know where to start. Do I go? They're just
tucked. An attorney would be correct.
Just say I want to.
I think it's more of an informational session with an attorney.
Usually what I do when people first come in, I don't make any assumptions what I think they want or what they need. I don't say, this is what you need. What I like to do is I like to say, okay, you have nothing. This is what's going to happen tomorrow if you die, you have nothing in place. This is what's going to happen if you have a will in place. This is what's going to happen if you have a trust in place. This is what's going to happen if you have a transfer upon death in place. And then just kind of lay out those the costs of doing all that. Because again, information is power. And I think that in order to make good decisions on what you got to do, you have to know what all of the options are.
Does that help?
I just had a question about the $19,000 gift, second gift. So back to Juan and Curtis. So if you have 4 kids and you give them each $19,000 every year for 9 years, for 4 years, does that apply to fall back to or not?
So what I always tell people is there's a legal answer and there's a practical answer, right? The legal answer is any kind of transfer that you've done, right? That is monetary value. If you have $19,000 and you have 5 kids, you're the math guy, but that's a lot of money, right? And so you know, the practical answer is though, every county does their medical systems differently. Every county looks back and says, we're just gonna not worry about that. We're gonna worry about it. So I usually tell people that the county, they're gonna look and they're gonna ask questions and stuff, but how stringent they're gonna be or strict on those rules, it's really their own policy, I guess. But the legal answer is yes, they have.
Yeah. And what you're referring to is a federal tax policy, and that may or may not play. Some counties may not care, what the federal tax code says when they're trying to recap, and they handle it differently. So, and that's that way in real estate as well too.
Finding out what's going on in your local area is very important. Emily and I at the compliance could lead that with that they would kind of in a situation where there might be some look backs and all types of trade with, and at the same time might have somebody that works in that county that was actually selling their home, and she does still never come up because they're 3.5 years to die. So, I mean, it just really kind of depends on, what the circumstances, and it's just to connect to nurse, but that they're 3.5 years behind on looking at within a nursing home, who needs to repaying via their assets and that type of stuff. They were that far behind on it. So, I mean, again, could they come back at it or whatever? But I mean, that was so knowing what the look back period on that would be, like how long do they actually have into it, might be something to know if you have information that tells you that those counties are super behind that stuff too. And if we're more user friendly than other, what's the most user friendly?
You're smooth.
It's a bit on that.
Let's switch gears. Let's switch gears briefly back to insurance.
Legal bit.
Michael, it used to be that there would be more of general replacement
First,
policies. Now it's more endorsement based, or everything's kind of an endorsement. Back to the question about does steel siding get covered for this and all of that. I kind of cringe when I see people getting insurance quotes. They go online and it's never going to be apples to apples. I always had a saying like most any company brokerage can write the policy. The real question is, will they pay a claim? And so you want to know what you're actually signing up for. It's not a one size fits all full replacement cost across the board anymore. I shouldn't say everything, but it's more and more a la carte is a better way to phrase it. Maybe speak to us or tell us about your experiences with that dynamic.
We're seeing a lot more within American Family, but also in other carrier. You can see that companies are going more to a la carte pricing, if you will. We used to have policies that would kind of American Family specifically. We had one. We kind of called it a Cadillac policy. We called it a Gold Star policy. It had everything in it. Whether you needed it or not, you got it. It covered just about everything. You could add a few endorsements to it, a few options to it, but it was all kind of baked in. And we had a couple different flavors, and that's how it worked for years and years. In recent years, that has gone much more to, we have a base policy, which is kind of the balance, the frame of the policy. And then you kind of build it out with what matters to you from an endorsement standpoint. My current Minnesota homeowners policy, I think I've got 5 pages of not quite single line, but almost endorsement options. And we go through those with clients, and there's some that I can say, yeah, you don't need that, or generally speaking, but things like cosmetic coverage on metal roofs and siding is a big part of the cost of that policy right now. If somebody wants that coverage, means it's important to them. There's an additional cost to have that. But on the other side, maybe they don't have steel siding, and they don't have steel roof. They don't need to pay for that coverage because it doesn't apply to them. And so we're seeing that a lot more where Randy can come in and we could run through quotes and get everything put together. And he had a similar home, but maybe it's a vinyl siding or a brick house. And he has something that is metal roof and siding and similar values, but wildly different costs because of the components that would need to be into that policy.
Yeah, and just to take that one step further, we've seen in the real estate aspect as agents in the last 2 years, especially with all the claims, and we're dealing with transactions while there's a claim in process or there hasn't been a claim yet. There is when you've done a number of transactions where there's storm damage, when a property is for sale and being sold, you see the different aspects of different insurance companies, what they will cover and what they won't. And not saying that some are bad and some are good and some are better, where the reason why I'm bringing that up is you really have to understand what your policy covers and what it doesn't. The biggest thing that is hard to see our clients is they're expecting one thing, coverage, and they're not getting that when they go to make a claim. So what are some questions that people should be asking you, like what is, besides deductible and all of that, because a lot of people just shop for premium, right? And that can be a little fool's gold if you're just shopping for premium. I mean, what should they be asking about? What kind of coverage do I get on my roof? Is it full coverage? Is it partial coverage? If one side of my house has hail damage, do I get the whole thing resided? Do I just get that side? How can you advise people when they're first originating a policy?
Yeah, so good things to be asking about are exactly those kinds of things. We get asked oftentimes, I need a apples to apples estimate of X and your policy options. And I learned this from an agent that I respect, but he said, it's really tough to do apples to apples because you might have a Honeycrisp apple and you might have a crab apple. And just to say they're both apples, you don't know what's in that policy. So I really recommend that people are talking to people that they trust, not just agents, but others that maybe have that insurer, friends and family that can help talk about what their claim experience was. Again, if you've got a company that is really hard to work with when it comes to trying to get that claim paid, that's an added cost that you maybe aren't paying in premium, but it sure is a heartache issue after the fact. So we definitely focus on that. When you're talking about replacement costs versus actual value, roof age, roof condition, those kinds of things are part of it. How your deductible would come into play in the event of a claim. It should be pretty simple when you talk to an agent or somebody that knows, for them to be able to give you a sort of what if answer. If this happened, what would that look like? They can't say exactly what it looks like because every claim is a little bit unique based on the time efforts and all of that. But they should be able to give you an idea of what that looks like. And it shouldn't be overly complex. I will say, if you go online and you're purchasing, from wherever you're purchasing, and I've said for years, if you don't have an agent, then you are your agent. And so recognize that you might need to know a lot more about what it is you're purchasing, or you need to have somebody trusted. It's kind of like you can go to a dentist or you can be a first, which you want.
Yep. No, that's good. One final topic I just want to touch on because it came up last time was for those of you, if any people in the room own investment property or not your primary residence, if you're familiar, the tax code, again, I'm not an accountant, none of us are an accountants up here, but if you occupy your primary residence for 2 of the last 5 years, it doesn't have to be the most recent 2 years, and it's under $500,000, you are exempt from capital gains on those profits. If it's over $500,000, or if you haven't lived there in the last 5 years, you would be subject to capital gains on your primary residence. If you own investment property or land, there are options, what's called a 1031 exchange, where you can roll those proceeds into other real estate investments, which are referred to as like kind. And there are timelines and all sorts of rules to that game on how to identify a property and when you have to close on. But there are some avenues in which you can take those proceeds, roll them into other real estate, and not be exempt from the capital gains, but it's what you defer them, so you don't pay them. If you ever were to cash out, you'd be subject to them. But it's a way to defer or not have to pay capital gains. And there's all sorts of reverse 1031s. It gets as complicated as you can imagine. But there are instruments out there for investment property on how to defer capital gains as well too. So if you have any questions on that, that's another topic you can reach out to any of us on, or myself on that as well too. But but what I wanted to say here, and I know Heidi has a couple more door prizes, but I think what I always tell people, you know, if you're looking for a real estate agent, a lender, an insurance agent, an attorney, whatever aspect, an electrician, my advice is always ask your friends and family who they have used and who they feel comfortable with. And you ask a number of people, you'll probably get 2 or 3 names that rise to the top. And then any of those 2 people are probably going to be more than qualified to help you and service you. And then it comes down to, who do you feel comfortable with? You have to work with them, and who do you just mesh with and click with? That's how I would recommend selecting. That's how when I'm looking for someone in a variety of ways, that's what I kind of do. And I think all of the great panel would agree with that as well too. So why don't you give it up for Andy, Lori, and Mike, and thank you. We appreciate your time. We'll be here hanging out for a little bit.